Okay, guys, today Austin Federa from Double Zero, longtime, well-known actor in the Solana ecosystem, now has branched out on his own. Double Zero launched the token launch recently. Did the actual network launch recently, or was that prior?
The network was in a testnet beforehand, where we still had like 15% of Solana running on it. But yeah, now the mainnet beta is up and running, and we've got about 30% of Solana running on it today.
Okay, nice. Okay, so like let's just do not too much background. I had one question specifically. Most of your time at Solana Foundation was more kind of like public facing, I would say. When I hear you talk about a lot of this stuff now, you seem to have a fairly technical grasp on a lot of it, which I'm not to say that like I was surprised, but I was. It seems like you really dug into, like more like the networking stuff, like HFT. You seem like very well versed. My question though is, was this something you kind of learned on your own, or was this like primarily from having worked at Solana for 4 or 5 years?
Yeah, it's a good question. So I started working in product and marketing at Solana Labs back in the very end of 2020 and into 2021. The head of comms thing kind of became a bit of an accident. It really was like there were 3 of us that organized the first year Breakpoint, but before that, like I was one of the folks who designed the stake pool program on Solana. I'm one of the co-founders of Metaplex. There's about 6 of us who kind of built that original vision of NFTs on Solana. So like my background is a lot more of sort of the operator and sort of the technical side of things than maybe folks realize. I'm not an engineer. You don't want me coding anything. But when it comes to system design and those sorts of components, I've always kind of been pretty in the weeds on that. The role ended up evolving into a more public-facing role because you I think too oftentimes in crypto, you have people who are communicating with the public, for lack of a better term, that don't actually understand the technology. And the engineers are too busy doing the actual engineering to be that communications layer. And so I kind of got like stuck into that a little bit. But my role was always sort of on sort of the architecture side of technical, I would say.
Okay. And so then you launched Double Zero how long ago now? Or like, when was the project? Like, when was the inception of the project? I think I recall starting to read the initial white paper and then putting it in ChatGPT. But
yes.
Yeah, like, so when was that? And then, we can kind of move into that.
Yeah, so we dropped the white paper in December of last year. But we only really started working on the project in August of last year. So there were really only 3 of us at that time, myself, my 2 co-founders, Matteo Ward and Andrew McConnell. And at that point, we had this vision for this thing, and a lot of that came out of the work that, we've been doing on Firedancer before at Solana. But it really kind of came down to this vision of like, hey, we can build a new internet just optimized for blockchain and other high performance systems. And we can actually do this in a way that has more censorship resistance than the public internet. And that was just an idea that like I couldn't get out of my head. And so I left a very good, very cushy job at Solana Foundation to go do something. Obviously, anytime you do something, I take a massive pay cut in that. And so, this has really just been like an incredible process of building out and launching Double Zero. And we've been live in mainnet for about a week and a half at this point. So the growth has been pretty crazy to see.
Okay, so then, go ahead. Let's hear the pitch for Double Zero. Also, so like I was telling you before, I listened to a bunch of your podcast prior because this is not a subject that I'm so well acquainted with. So I try to listen to a lot. And as such, I'm going to try to talk about things maybe that you haven't already spoken about. But for context, you describe Double Zero as like this layer 0, right? And that when we actually interact with what we call layer 1s, there's a ton of, this is like maybe 5 or 6 or 7 on the stack of sort of the protocols or networks that we're interacting with. What do you mean by like layer 0? And then, like maybe what does the new internet mean as well?
Yeah, totally. So, crypto is this problem where we name things dumb things that already exist in the rest of the industry. We've done this for years. So a layer 1 blockchain is actually like in OSI terms, like layer 5 and 6 on like the computer science stack of the world. And so people are always confusing, like it's a layer 1, like you're physically interconnecting stuff. Like, oh, no, like that's not what we mean by layer 1 blockchain. So you can sort of think about this as everything we do in blockchain space exists in a pretty high level of abstraction. So, unless you're really getting into like the stuff that like Solana does with like CPU optimization or like Succinct does, everything else is basically an abstraction layer. It doesn't matter if you're running on an AWS instance or a bare metal server. It may, from a performance standpoint, but it's just software, right? The idea is like you can install Linux on anything. You can install like the Solana validator software package, the Ethereum validator software packages. They all kind of just run on everything because they're not actually optimized for the hardware they're running on. They're just software running on hardware. And this is sort of the promise of the cloud. And this is kind of the way most modern computer science is done. When you get into trading firms, and the work that they do, they are actually like a lot of the work that takes place at a trading firm from a software engineering standpoint is getting rid of all the crap that like the OS vendors and Intel and AMD put between your code and the actual hardware. And so a lot of what they're doing is just like ripping out all these APIs and frameworks that are designed to make it super responsive and easy in a desktop environment, but absolutely kill performance when you're talking about like an optimized level. This is even further below that. So when we talk about like an OSI layer 1, 2, and 3 network, what we mean are the physical hardware, like the cables, the fiber optic lines, and then the protocols that run over them, but not the protocols like, oh, this is TCP/IP. The protocols like how much voltage and, do you send down this line? This is very low level type stuff. And so what that means is we can support all types of high performance systems on top of it. But by going down and drilling down to the lowest level of the networking stack that you can drill down to, we can really optimize performance from the base layer up. And this is something that the internet never does and never was built to do. The internet was not built for it to be a performance system. It was meant to be a resilient and a reachable system. And this is why, if you look at like, there's no financial firm in the world that uses the public internet. There's no big technology company in the world that relies on the public internet. They all run massive private networks because the public internet's too slow for what they want to do. And so our whole innovation was, okay, you've got FireDancer and Agave on Solana that are starting to really get down to low-level hardware optimizations. Like there's this whole thing called tile architecture in FireDancer, which is very common in the trading space, where you basically say, I need to look at the physical topology of this CPU. Where are the cores? Which ones are performant? How much bandwidth interconnects them within the chip? If I'm trying to move from this core in this corner of the chip to this one, that's actually going to be really slow. So let's make sure that if these two processes are run sequentially, they're physically next to each other on the chip. And like this is the type of optimization that like is very common in the trading space and is no one in crypto's even begin thought of. And so the minute we get software packages that are thinking about like optimizations at that level, suddenly we need high performance networks to be able to actually make use of all of that performance. Because right now we've got like a Formula One car stuck on a dirt road. Like the thing is built for like a perfectly flat, high performance surface. And you're just, you're going to go slower than like a 1970s pickup truck if you try and run it on a dirt road.
Got it. Okay. So then that kind of leads us in then to the actual design of 00. Yes. You guys have partnered with just take from there. I guess you partnered with a bunch of firms that have these sort of private networks. Yeah. Explain like the process and like what exactly the rationale behind that is.
Yeah. So we have at this point 11 independent contributors, and that includes everything from trading firms like Cumberland DRW and Jump and a few others to bare metal providers like TerraSwitch, Latitude, Cherry servers, that run data centers and hardware. We've got, transit networks as well, which are folks who are basically, they run networks professionally, that are contributing fiber to this. And then we have even VC firms who've said, hey, the way we might run a validator normally on a network, like we're actually going to go and we're going to like just Distributed Global did this. They're building out a global fiber network to contribute to 00 to earn rewards as a way of increasing their 00 token holdings. So there's all sorts of different actors involved in this. But fundamentally what they're doing is they're going out and taking leases on, some of them have direct ownership of existing fiber, in the same way that, Google or Microsoft or Apple does that when they want to expand a fiber network to a new area. And they're contributing that to the 00 network. And when I say contributing, it's like there's physically a guy in a data center somewhere plugging two cables into each other. Like it is a physically interconnected network from that perspective.
So I heard this was like quite an interesting quote, and it makes intuitive sense. I heard this, you say this prior, which is that this idea of like, highly optimized networks is actually it's not a business or a system designed around network effects. In fact, it's like quite the opposite in the sense that like a lot of these, for example, some HFT firm has put in a tremendous amount of, investment and time into building this like highly optimized cable across the ocean or whatever. They don't want their competitors using it. It's a competitive advantage. why now? Like, why are they opting into this now?
Yeah, so there's two reasons. The first is quite simply the problem is too big for any one firm to solve. So if you think about it, there's maybe 10 financial centers in the world that really truly matter. That's a pretty small number. Like if you're a Jump or DRW or Citadel or, someone like that, you can wire up all of those cities and you can compete with one another. And it's hundreds of millions of dollars, right? If you're really truly competing with one another, but it is like a very tractable problem on the income stream of these trading firms. Crypto is different. Just Solana has over 300 data centers validators are running around the world. You add Aptos and Sui and Monad and MegaETH and even all the places that Flashbots runs MEV centers and all the Jito block engines. And suddenly you're just at a size of network where it's very hard for a traditional player to say the CapEx and OpEx make sense to build this thing if I'm the only source of monetization for it. And so what we basically set out to do was to say, hey, the aggregate trading experience for everyone, the aggregate validator network experience, the speed at which Solana can operate will go up if we can just get everyone connected to this thing. And right now, market makers on crypto are really struggling, and they struggle because of the public internet. That's one major component of where they struggle because, if you think about this in a traditional exchange, I always know my time to execution. I know that from my trade server to when it hits NYSE or Binance or wherever I'm trading on, it is a fixed number of milliseconds, and I'm functionally guaranteed to get inclusion. On blockchains, not only is inclusion not guaranteed, right? That's a whole other component, but the amount of time it takes to talk to the leader changes dramatically. Not just because the leader keeps moving around the world, like the person building the block literally moves every 1.6 seconds on Solana, but the public internet is so high latency and so high jitter that even if I'm talking to the same city, it might be 300 milliseconds this time, 900 milliseconds the next time. And that lack of variability means that market makers can't quote as tight because they have to be able to accommodate a much wider range of market movement. And that's just one example of where there's so much room for optimization in this space. And so these folks all basically came together and were like, look, we want to contribute to this consortium. Like Galaxy is a great example. Galaxy's our market making activities will be more profitable because of Double Zero. Our trading activities will have less risk because of Double Zero. Our Solana holdings will be worth more because if Solana goes to 500,000 transactions per second, their thesis is that'll make it some amount more valuable, which I think is a pretty fair thesis to have.
I wanted to ask you just quickly to clarify this because you hear this a lot when you're talking to these market microstructure people, and this is this idea of jitter, right? So latency is essentially just speed to ping, any server or whatever, around the world. Jitter is sort of this standard deviation between how, right? So but I had a specific question about this. So normally maybe you have 400 milliseconds, and if it goes down to 300 or 500, there's that would be considered a lot of jitter in my understanding of it. Can you have high, could something be 900 milliseconds? I guess let's just say that's comparatively slow, but still have low jitter in the sense that it's consistently 900 milliseconds. Would that be low jitter, or is it also take into account the speed?
Yes. So jitter is only a measurement of variance.
Okay.
So for example, a really easy example of this is if you're driving from JFK to Midtown Manhattan, that can take you 30 minutes or that can take you 2.5 hours. And that just depends what time of day and if there's any construction, if there's any accidents. And so if you run that route 100 times, you're going to get a huge amount of variance in how long it takes you to get there.
Yeah.
That's jitter.
Okay.
And so you can have a very high latency connection that is consistently high latency. And in some ways, that's actually a much easier, much better environment than one which is high variability. Because if you think about it, every time data arrives out of order, you've got to stick it in a buffer. You've got to stick it in a queue and say, okay, I can't actually do anything with this yet. I have to wait for the other pieces to come in. And so every time data arrives out of order, which is basically what jitter creates you're in a system where you're just queuing and queuing and queuing. And the most expensive operation in a modern computer is getting something from RAM. God forbid you have to get it from disk.
Yeah.
But it's this whole very funny thing where if you look at what actually takes time in a transaction on Solana, or let alone Ethereum is way worse than this, but on Solana, the compute units does not dictate how long it takes a transaction to execute. The only thing that dictates how long it takes a transaction to execute are how many accounts it touches. Basically, how much data do I have to pull in from RAM into the CPU? Just waiting for the electricity to get from the RAM to the CPU is like 95% of the time it takes to do a transaction.
I see. Okay,
it's
so
really interesting. Yeah.
You've talked a lot about this, how like one of the sort of goals, the like foremost goals of 00 is to reduce jitter.
Yes.
How does it do this? Like from a not too technical, but in a like enough detail that I would, find it interesting, I suppose.
Totally.
How does this work?
So to continue with kind of the roadway metaphor, it's just a dedicated highway.
Okay.
Like it is a flow controlled dedicated pathway where instead of having to take all these county roads and go through different cities and slow down at stoplights, that's the public internet. We use direct routing on direct fiber. So if you, for example, if you are going from New York to Tokyo, you are probably going from New York to Chicago, Chicago to Seattle, on 00, New York to Chicago, Chicago to Seattle, Seattle to Tokyo. Zero jitter, 3 interchange points. You're basically like, at worst case, you have like 1 millisecond of jitter. If I'm doing this on the public internet, my data might bounce up to Chicago and then down to Atlanta and then over to Dallas and then over to Austin and then up to San Jose and then over to San Francisco and then up to Seattle and then back down to San Jose. And then it might take a cable that goes all the way to Singapore and then work its way back up to Tokyo. And the reason for that is every single provider on the public internet is incentivized to get your data off their network as quickly as possible and as cheaply as possible. So it's not about how do I move this data closer to its destination in the most efficient way possible? It is how do I move this data closer to the destination for as little money as possible? And sometimes the easiest way to do that is actually to move it backwards.
Got it. Okay. So then going back to what you said prior, which is that market makers have a lot of difficulty, probably for a number of reasons on blockchains for what it's worth, but especially because of this idea of like the public internet. But is that what they're doing now? Like what are they doing now? Like Wintermute is market making. So they're using the public internet.
They're using the public internet and they're having this is why on-chain quotes are not very good compared to centralized exchange quotes is that like when they're market making on Binance, they know exactly what the book looks like. They know how long it takes to get there. The other thing to remember is it's not just about landing transactions for cancels and those sorts of things. They don't know what the market is. Like if their trade server is in New York and the block was just built in Singapore, they have to wait till they get the data from Singapore to even see how the price has changed.
I see.
Right. And so when you think about it that way, there's so much variance and like kind of the question of like market making doesn't exist in the traditional markets. Not really. Right. There's designated market makers, but it's a whole different type of thing. No one hires a market maker when they're like listing, a token on like the stock exchange.
Yeah.
Because just the way the markets work, they're way more efficient because they don't have all these structural issues built into them.
Yeah. So like that's a good kind of point. I think everybody has read or heard of Flash Boys, right? Like how analogous is to that, right? Like there was people digging through granite, right, across like in parts of the Midwest in order to get the fiber in like the most optimized path. Like, can you draw some similarities and differences, right, for somebody who like maybe has a rough understanding but isn't really in the micro, especially in the infrastructure side, like microstructure, if you will.
Yeah. So Spread Networks was kind of the network company Flash Boys was kind of all about, and like I think. In retrospect, maybe we can accept that Michael Lewis embellished a little bit in some areas. If you've read his book on FTX, maybe he's not the most trustworthy author when it comes to this stuff. So a lot of his conclusions about HFT are like completely wrong, and really has been proven wrong over the last 20 years of cheap, abundant trades. But from a technical perspective, what they were basically doing is running one line of fiber in the most direct route possible. Now, Spread Networks, by the time that book came out, was actually out of date and had been eclipsed by other networks because there's so much money to be made in being slightly faster. But that really is like the type of thing we're building for blockchain, except instead of one person owning Spread Networks or one PE firm owning Spread Networks, the 00 network is owned by all of its contributors and all of its token holders. And so, what we are really building here is like a consortium network owned by all of its participants. to power all these types of high performance distributed systems. But at the end of the day, like the core concept is the same. Is like, how do we get the highest performance direct routing between cities people want to transact between?
Yeah. So then to this like fiber notion, for example, I don't know if this is a good analogy, but like Jump owns some fiber optic, like extremely, purpose-built fibers, and they contribute it to the 00 network. I know that you guys have already partnered with them in some capacity for this. So they contribute. Does this not is the premise that this does not at all degrade their usability of this? And that's kind of goes back to the initial question that I was asking, which is like, why now? Like, why weren't they doing this prior if this has no sort of impact on their own internal, whatever they do, lines of business?
Yeah, totally. So the way that this basically works is they are carving out a portion of their network to contribute to 00. And so they can't really take it back on demand. It is obviously they can, uncontribute it to the network, but it's not like a variable amount. Like they've say, hey, this is how much bandwidth we're contributing to 00. And that's fairly fixed over, a 30-day period. And so basically what this is usually not their highest quality fiber, right? So you can think about this from the perspective
it's great for a blockchain, but not great for their...
It's incredible for a blockchain. If you go to 00.xyz/dashboard, there's a whole network metrics section. There are areas we beat the public internet by 82%. And so even this stuff that is really, really, it's all very high grade fiber, but it's not the stuff they're paying $300,000 a month for, right? It's maybe the stuff they paid $300,000 a month for 4 years ago.
So just one quick intervention here. Sorry to interrupt, but okay. Jump is itself contracting with the actual owners of the fiber. They don't own the actual cord.
So even in the case of something like Facebook, where they're financing 100% of the construction, they are the actual employees on the ships who lay the fiber. They work for specialized companies that do this because there's just not, it's sort of if you're building an office building, all the construction workers don't work for you. You hire a company to build the office building for you. So it's the same type of thing. So in Jump's situation, almost all of their fiber is on leases or long-term agreements. And that's because new fiber and new faster fiber keeps getting put in all the time, and they want to be on the upgrade cycle.
Got it. So, but when you say they're contributing their not highest quality fiber, is their highest quality fiber primarily being used in TradFi markets?
Yeah, I mean, they have it for all sorts of reasons, right? That you'd have to talk to them about exactly what they use it for. But a lot of the stuff that we have, you can think about it as if you are a high frequency trading firm, you want to be dumping all of the market data somewhere so you can run regressions on it. You can basically model how your network did, and hey, if we tweak this algorithm, could it perform better? So all these high frequency firms, they run big data transport networks to basically get all of the nanosecond by nanosecond market data from a market after it closes somewhere, so they can compute it and they can run testing and say, hey, if we, our quant came up with this new algorithm, how would that have performed yesterday? Would that have beaten what we had in production yesterday? What about 4 years ago when this crazy market event happened? And so they have all this historic data that they keep to do simulations. It's very funny because the setup of a trading firm nowadays for simulation modeling is very similar to a particle physics lab, where they're just sort of hey, we have all this data stored here. We have all this compute we can do on it when we have new theses about what would happen. There's actually a decent amount of overlap between people who work at particle physics labs and people who work for trading firms because the problems are surprisingly similar. But this is, suffice to say, they have a giant data transport network all around the world, and most of these firms do as well. Fiber is not used a ton for active trading anymore in the top tier firms because it's actually too slow, which is a crazy statement. But the speed of light, so the speed of light through glass is only about 2/3 of the speed of light. So if you go through the air, it's faster. And so that's where microwave towers were a big thing for a while. Now folks are even using shortwave because shortwave, you can bounce it off the ionosphere. So it's very the same way that a ham radio your granddad maybe used worked. It's a big long wave radio tower. You can actually, outside of Chicago, near the CME and stuff, they're these like pieces of farmland they're selling for like insane amounts of money because people are just buying them to put up shortwave antennas.
Fascinated. Okay, so then you say that fiber is actually not the most optimal
for trade execution. Yes.
Okay, so then what is it optimal for?
So fiber in trading firm capacity, fiber is by far the cheapest per gigabit per second, and it's the most dependable by far. So microwave towers, a big storm blows in, you go from 3 gigabits per second to maybe 30 megabits to maybe zero connectivity. And so the advantage of fiber is it's not impacted by weather. It's not impacted by anything else like that. It's photons through glass. So even like an electrical storm doesn't really impact it that much, or, high voltage events or something like that. So really what you're at is like fiber is the gold standard for transporting large amounts of data, and it's incredibly rock solid and dependable. And so almost all of these financial firms, they have a backup trading network that runs on fiber.
I see. Okay.
And additionally, you can think of we think of trading as very like one-off events, but it's not a one-off event. So if like, let's say I'm a trading firm and I have trading servers in London, in Chicago, in New York, and in Tokyo. Every time one of those servers makes a trade, it moves the market. Even if it's a tiny trade, it moves the market slightly in one direction or another. So I want to make sure I communicate out my trade to my trading server in Chicago and my trading server in London and my trading server in Japan as well, because the more information they have about what trades are coming or what trades are actively being made, the better those systems can predict where the market goes. And so the last thing you want is your London trader and your Chicago trader to be trading against each other. Like this literally happened to like AIG during the financial crisis, is one side of the firm was offloading toxic debt. The other side was like actively buying it because they thought it was like good. And so there was this crazy thing where they were basically just like setting money on fire to offload the stuff at a discount to buy it at a discount on the other side of the house. And so, you want to make sure that there's enough intelligence on your own systems and your own trades that you're not sort of trading against yourself. And that's where a lot of these firms still rely on fiber, is to communicate this stuff that's very important, but it doesn't necessarily need to be quite as mission critical as like, buy this right now because I think the market's about to move up, or sell this right now because I think the market's about to move down.
Interesting. Okay. So then talk to me again a little bit about like the different actors. So we have Jump. They have some fiber that they can offload to 00 and opt into this network. You also talk about how this is, I've heard you frame it as like very much a hardware meets base infrastructure problem. Like talk to me about the different people within this system. Like who would opt in, who doesn't necessarily need this. I heard you like talking, this wouldn't necessarily benefit the average person, right? Like this isn't a better internet currently for like us doing this, on StreamYard right now. But so yeah, tell me like the different actors and like where their roles kind of come in.
Yeah. So in the blockchain space, the number one actor is consensus networks. And so the reason for this is if you get all the Solana validators and the Monad validators or whatever connected into this system, we can use technology that's not available on the public internet, like multicast, which is basically hardware acceleration for packet replication. And it means you can reach consensus much more quickly. Everyone, like votes can, instead of having to send your vote to 2,000 nodes, you can just send it to a multicast group and everyone will get it. And now that like Alpenglow runs on signature aggregation, a bunch of other systems now run on signature aggregation. This is a much faster way to actually vote on a block. Plus, you can do the same thing with state transitions. And so it just allows all these networks to move much more quickly than they are today, which means you can drop block times, but also you can increase the size of blocks because now you have more capacity to be able to move data around. So that's kind of at that base layer there. And then we can go into all the other use cases, but I want to just hang on that for a second to see if there's any.
That's good. That's good. I mean, I guess one thing is like signature aggregation has been like one of the, like, I don't think in Ethereum, this has been like one of the big, like, holdups, right? I forget what it was like with PBS or something, maybe the actual like aggregation of signatures is like the big time suck, if you will. Okay. So
it shouldn't be on the public internet, it makes sense that it is. But if you run these things on 00, it's just a multicast group. So like multicast, maybe it's worth explaining a little bit. This is basically the closest you can get to FM radio for digital signals on the internet. So the beauty of FM radio is one person can be listening or 100 million people can be listening. and the tower is still just doing its thing and broadcasting its radio waves. Each additional person listening is not a tax on the system. That's not true about YouTube.
Right.
That's not true about streaming the Super Bowl. Each additional person watching the Super Bowl is an additional amount of bandwidth and data that has to be sent out to their house.
On that note, though, like, let me just go back, and this is like somewhat tangential, but does that apply to these fiber cables? Like, can they get overloaded?
So yeah, absolutely. Everything has a data limit. But the advantage is when you're using multicast, like let's say that let's take an extreme example. There's one validator in London and 1,000 validators in New York City. Today, over the public internet, that validator in London will have to send 1,000 copies of the data across the Atlantic. With 0.0, they only have to send 2 copies across the Atlantic because the replication happens as close to the edge as possible. So the data would get from, London to New York, and then the switch in the New York data center would say, okay, now I'm going to make 1,000 copies of this data. And because the switch has hardware in it built specifically to copy packets, it's like trivial for it to do.
Got it. Okay, so then we have these validators, and then talk to me about who else would opt into this. Like maybe Wintermute is a potential customer at some point on the grounds that like this is just a much like more optimized trading system for them. But like tell me how they opt into something like this, or other actors as well. RPCs, like I think you've gone through like a list, but yeah. Explain more on that side.
Yeah. So RPCs are like a really big component of this too, because they're the ones that are sending transactions. And so what you want is when they're sending a transaction, they're racing to a leader. So if that leader's in the same data center as them, that could be 5 milliseconds. If they're on the other side of the world, well, suddenly it takes 250 milliseconds, 500 milliseconds, 900 milliseconds for that data to actually get to that server. And so if it's running over the 0.0 network, it will have the fastest path there possible. This may not matter if you're opening Phantom to check the amount of Monad airdrop you got. This matters a lot if you're trying to buy an NFT, trade on a DeFi market. Speed really is the name of the game in anything that's competitive. Non-competitive situations don't really need speed as much, but competitive situations, speed is basically the only thing that matters. And so if you're wanting to make sure that you don't get liquidated, you have to top up your balance on your loan, or conversely, if you are trying to liquidate someone, you really want to get that liquidation before anyone else does. And that's kind of one of the main components of why speed matters.
Let me take a moment to talk to you about Ellipsis Labs, a team I've known for a while building some of the most interesting products in the space. The Ellipsis team is one of the few that I can consistently point to and say, these guys really know what they're doing. They're backed by Paradigm, Electric Capital, and Hahn Ventures. The founders, Eugene and Jerry, have experience at Citadel, Jane Street, and the Solana Core team. Since launching their order book DEX, Phoenix, they've done over $80 billion in trading volume by making on-chain order books competitive with centralized exchanges. They are also the team behind Gavel and SolFi. I would consider them the foremost experts in crypto market microstructure. The best part is Ellipsis is hiring for New York-based engineers. Work with a small, focused team who are results-driven, collaborative, and use a modern stack. If you're an engineer who wants to work on infrastructure that's already proving itself in the market, go to ellipsislabs.xyz. Okay, now back to the show. Okay, so these, I think on your site, it says that so almost 30% of the stake weight is that on Solana is currently opted into 0.0?
Yes.
Okay, so how does that actually work in practice? Like when they opt in, like explain the kind of go ahead.
Totally. So what happens here is, if you look at the map on 0.0.xyz/dashboard, this is probably the easiest way to kind of visualize this. But these are all of the fiber lines all around the world. And everywhere where there's a square is basically where there's an entry and an exit point for the network. And so if you sort of look at one of these like cities, like, Prague is kind of a nice example. What you can see there's 12 validators that are connected into that device. And that doesn't necessarily mean they're physically cabled to the device. We basically create these short haul software tunnels that if you're nearby one of these devices, say in the same data center or something, it'll basically create what's effectively a VPN between you and the device. That's very short though. That's usually, tens of meters. Sometimes it's maybe a kilometer or two if you're going between data centers. But it's basically just a way to skip the need for everyone to plug cables into themselves. And so then what the validator has is basically like they're virtual, but 2 Ethernet ports. And on one Ethernet port, it's connected to the 0.0 network. On the other Ethernet port, it's connected to the public internet. And computers are really good at understanding what's available on each of these two network links. And so if I'm a validator and I'm trying to talk to a validator that's also on 00, I will talk out the 00 port. If I'm trying to talk to a validator on the public internet, I will talk out the public internet port.
So how much faster or better, however you want to describe it, are validators running 00 than those still just on the public internet?
Yeah, so it depends.
Ways to quantify
totally.
that.
So it depends what metrics you're kind of looking at. One of the things right now with Solana is, this is kind of ironic, but the way the protocol is built with MEV in it, he doesn't really reward you for being super fast at the moment. And so that's getting sort of tightened up a lot. And so that's kind of a big area we expect to see a lot of improvements. We had this crazy liquidation event a few days ago. And what we saw during that period of time was the 00 network performed anywhere between 10 to 60x better than the public internet in terms of jitter. And so it had much more consistent data delivery, which, really helped validators and RPCs kind of keep a hold of things during that period of time. And so we don't have we have very few RPCs operating on the network today. They're kind of in a testing phase, but as we get more and more, we expect to see kind of additional financial rewards. Right now, there isn't a huge financial difference between operating on the network and not operating on the network, although there's a lot of differences for network health. But our end live and die is going to be, can we make validators more money by operating on 00?
It seems just intuitive that if this works the way that it is working, or you intend it to work, that everybody on Solana will run 00.
Yes.
Okay, so
that's very much the goal.
Okay, so if you don't opt into 00, you're going to be at a huge disadvantage. Is this generally your thought?
At some point, yes. That point is not today, right? Today, what we see is a lot of early adopters that are very excited about new technology. What we will eventually see is if you're not getting multicast feeds for state updates, you're getting state slower than other people. And you can still run a validator that way, but it just, the chances are it's not as profitable.
Yeah.
Yes.
Okay. I
so
want to ask,
it's sort of the same way that if you're a financial trader, you can operate without a private fiber network. It's just much harder and you're likely to make less money.
That makes sense. I'm just looking at this map right now. It's quite interesting. You said that being fast is not actually the most important thing on Solana right now for MEV.
Yeah.
What is the kind of reason for that?
So the MEV auctions are 200 milliseconds. So there's basically a 200 millisecond speed bump in a lot of transaction processing at the moment. That will go away with Jito's new BAM architecture. This is just something specific to the block engines at the moment. And so we think it sounds like BAM's about a month out or so. And so once that happens, we expect to see a lot more advantages to the 00 network.
Yeah. Okay. Going back to the people who opt into this, explain to me, is 00 a blockchain unto itself? Is it a lower layer actual blockchain, or would you call it something else?
Yeah. So, there's sort of two different components to this. The first is the system runs autonomously and with, checks and balances, and it basically reaches a form of consensus on how the network routes are going to be decided. There is a blockchain that supports all of this, but it's not sort of the switch logic is not running as a smart contract or something. They're basically parallel things. And so you can think about this in networking, there's a control plane and a data plane and a management plane. And these are kind of three different levels within the switch. And the lowest level is basically everything is hardware accelerated. And you can think about that very similar to an electric, a gasoline engine. Everything is hard built. The pistons are moving. It's doing all this stuff. But then there's sort of this computer that controls a bunch of parameters for the engine. So maybe the amount of fuel that's being injected in, or the compression ratio, or, all of these things to make sure that the hardware is running in its optimal performance. And then there's kind of the telemetry on top of it. And that's all of the stuff that's logging engine performance, making sure that there's no alarms going off, that there's no data sensors that have gone offline. It's the thing that turns the check engine light on, all that type of thing in your car. And those are kind of three different levels. That third level is basically where our blockchain operates. And so we do have this thing called the 00 ledger. It is not a user deployable smart contract network. No one's ever going to deploy a DEX on this thing or something along those lines. Right. We don't want to be competitive with the majority of our users who are layer 1 and layer 2 blockchains. So there's kind of no reason we'd ever do that. But that's basically how the system runs. And that network provides telemetry. It provides all sorts of other kind of insights into what's going on the network. And that's actually on the 00.xyz/dashboard. That is actually all pulled from on-chain data. So all of that is not being sourced from some private database or something along those lines. That is coming from the 00 network ledger.
So I would kind of think of it as a parallel internal ledger, although it's maybe open, but
yes.
in the internal insofar as the actors within the system are sort of the validators, if you will, for that.
Yeah, exactly. Because this is not a stateful network, right?
Exactly.
This is, yeah. So on a proof of stake network like Solana or Ethereum, you have to secure $45 billion of USDC in perpetuity. All the 00 network is securing is data in flight. And so it doesn't need this kind of massive security budget and all these other things that you see from a typical blockchain.
How do the economics work? From this supply demand side, and then given that it's not this proof of stake, stateful network that has, explain all of that.
Yeah, totally. So validators pay a seat fee to operate on the network. And that seat fee basically, is denominated as a percentage of their earnings. And so they pay in.
Sorry, explain that. When you say percentage of their earnings, you mean?
Yeah. So if you take in, 100 SOL in block rewards, we would charge you about 5% of that.
Okay. But it's, okay. It is from the observable Solana blockchain, what the percentages there. So in many ways, depending on the actor, you may not know exactly how much. It's only from what you can kind of observe from.
We can only attribute on-chain revenue.
Got it.
Yes, we have no ability. There might be some weird side deal they have with someone.
Or arbitrage, where I'm just pointing out kind of that in some scenarios, right? Market makers are making, you go back to sandwiching.
Yes,
totally. It was very difficult to tell, SexDex-ARB, right? You have no idea their Binance side of the trade. So I'm just
exactly. Yes. Yeah. And even in that situation, basically what so this is on the validator side. So validators, we just charge a percentage of block rewards. On the RPC side, there's basically a pay per transaction model, and there's multiple levels of priority that you can send it on. So very similar to how Jito tips are not content aware, we take the same approach where we're not, because it would be weird to charge you more money for a successful arbitrage and less money for an unsuccessful arbitrage, because the network doesn't actually determine whether that arbitrage is successful. What determines whether it's successful is the state you're trying to modify on the blockchain.
Got it. So the validators are charged 5% in 00 tokens. Is that correct?
Yeah, but we get it kind of indirectly. So basically what happens is, RPCs pay in 2Z natively.
Okay.
As you might know, we've had a bunch of centralized L2 sequencers that have forgotten to top up their ETH balance and gone offline. And so we don't want to kick a bunch of Solana validators offline by having them not top up their 00 token balance. And so what we basically do is allow them to divert a percentage of their earnings in 00's token. Exactly. And so then it's swapped into the 2Z token using DeFi. About 50% of those rewards are burned, decreasing the supply of the token because there's no inflation on the token. And about 50% of those rewards are then distributed out to the Fiber contributors as basically rewards, the same way you get block rewards, right? It is basically you've provided Fiber to this system and that Fiber was used, and therefore we're rewarding you for the use of that Fiber.
Okay, and so then the other side of it, the contributors of Fiber and stuff are then subsequently paid in the 00, minus the 50% burn. Got
exactly. It. Yes. And so the thing also to remember is that, in order to, so we basically run you can think of it as a one-sided AMM where we say hey, we have X amount of SOL or APT or SUI or whatever. And the only way you can buy it from us is by giving us 2Z tokens.
Got it. I see.
Yeah. And so there's kind of balanced pressure there.
Yeah. So right now, I think you guys are primarily active on Solana from what I can tell, but this is intended to be the new internet for any and all blockchains that require high performance. Like,
yes,
you mentioned Monad. I know there's like there's other like L1s launching soon, maybe that are going to opt in as well. But does the protocol design change at all for them? Like, is it just a plug and play, or do you have to kind of custom like create like a bespoke new version of 00 for their unique chain?
If you just want to adopt 00, you can do that, and there's very little modifications required. If you want the maximum that you can get out of the protocol, then you do need to do some modifications to your client. You have to add support for multicast. Ideally, you want to add this support for different levels of prioritization of data from a trader perspective. But because this is an OSI layer 1, 2, and 3 network, you can basically do 0 modifications to your client, and you can get up and running on 00 in like a day. And then it's kind of an 80-20 rule, right? You can get a whole bunch of the value just by operating on 00 because it's faster pipes and fatter pipes, for lack of a better term.
Yeah.
But if you want to use all this technology that isn't available on the public internet, you've got to integrate that technology.
I see. You tweeted, I think, recently that there was 23 billion in total connected value.
Yes.
What exactly does that mean?
So total connected value is exactly what it sounds like. It is the sum total of the assets of the validators that have opted to connect to 00. So saying 23 billion of total connected value and 30% of Solana are running on 00, it's the same thing. The difference is that, we're going to have to say like 30% of Solana, 18% of Monad, 39% of Sui, 45% of App.
So you come up with a new acronym.
Exactly. So instead of having to do a laundry list of, all the networks and what their relative percentages is, just sort of like how TVL is like one top line number that includes Ether, stablecoins, Fartcoin, all of these different types of assets that make up TVL, it all rounds up to $1 amount. So total connected value is the sum total of everything connected and operating on the 00 network expressed in US dollar value.
Got it. You mentioned, going back for a second, it's kind of an interesting point you said regarding the, like, not wanting to throw some RPC off because they aren't, holding a certain amount of 00 token. Do you expect some requisite kind of supply sinks from participants that are going to just like need 00 in perpetuity? Or do you expect this to be something where it's kind of what you're saying with like just in time almost, that it's swapped? Like I guess my question is, like, are validators going to be holding 00? Because it's not a proof of stake network. That's what's kind of interesting about this, right? Yes. There's not like some like sort of designed illiquidity sink or something. It's like very much fluid and constantly flowing. So do you where do you see like the holders in this scenario? Not to say there won't be, but like just out of curiosity.
No, totally. So we will have staking at some point live because we do need this sort of whole resource. We call those sort of resource providers, but effectively what we need a bunch of boxes run by independent people providing checksum math on things that the network contributors are telling us. So we basically need but computers that are verifying that like the telemetry makes sense, that are doing things like catching anyone who's lying about their latency. There's a whole bunch of kind of like, trust but verify that goes on. And the verification piece, we need a bunch of folks doing work for. That will likely, though, just be a percentage of reward diversion. There's a chance it becomes some sort of like 1 or 2% inflation, but I think that's pretty unlikely just because we don't actually need a ton of cost on that.
Yeah.
RPCs will consistently need to pay in 2Z, though.
I see.
And so I would assume that just like anyone who regularly needs to spend a currency that has a volatile value picks certain moments to, get more of that. The other one, too, is that this whole DeFi swap that we've built out does require 2Z to work.
Yeah.
So if there's like, there's 500 SOL that are available in this thing. And if you're like, look, the marginal price of 2Z versus SOL, I can arbitrage, 10 bips here. Like, you're going to go take and hold a bunch of 2Z so you can make use of that economic event.
Is like somewhat akin to, like L2s on Ethereum need to have some, like at times more, but, some amount of ETH, right, to post data and whatnot. Going back to the kind of people who have opted into this, Jump has contributed some of their cables. Okay, I keep coming back to Jump because it's like the one I hear about, and I know you guys kind of collaborated in this whole thing. Jump contributes some amount of their cables. You have a contract with Jump, like the 00 protocol has a contract with Jump. Like how does that work from, I don't want to say legal, but just like some assurances, right? How does that work?
Totally. So Jump is one of the core contributors to the 00 network. That is kind of one of its core principles and value propositions here. And so we work with them very closely on a whole bunch of different stuff related to that. And so that's kind of one big component here. I would say the other component of this is they're a network contributor. And then lastly, they're also an investor. And so they have a multi-year technology commitment, both on as a core contributor entity, and then also as a fiber contributor to the network.
Okay, let's like use the same analogy, but with somebody who's not Jump, who's just recently opted in. What prevents them from rugging? Like not rugging literal money, but just saying they're going to contribute some fiber or some infrastructure, and then say, nah, actually, like, turns out we need this, or we don't want to contribute. Like,
right. Totally.
What prevents that? And I guess the idea, right, is that you have enough actors within the system that there's some, not censorship resistance, but like you understand, like there's some fallback, right? Like, and that's kind of the premise of creating the network as a network of, independent validator or independent actors as opposed to just Jump. So, but like what prevents somebody else from just saying like, I don't think we want to contribute to this anymore.
Yeah. So, I mean, there's a whole bunch of different things that kind of go into that. So one of them is we hold 10 epochs of rewards basically in escrow, and that is kind of the slashing budget for the network. Anyone can basically leave the network at any time. Of course, this is not like a hard lock-in network or something like that. And so they just have to withdraw and basically deactivate their fiber links. And there's a 30-day provision for that. The same way, if you're turning off a validator, you have to announce that you're going to do it, or else you'll get slashed.
That makes sense. Or you were talking about how like eventually there's going to be some kind of like proof of stake to kind of for people to check that other contributors are not lying about their latency and whatnot. Is there any other like shenanigans that contributors could play? Like they can't like reorg transactions, right? Like it's not like that level of the stack, but like what kind of like little games could be played, right? If somebody opted in and was sort of acting maliciously, what would that look like in practice?
Yeah, so there's some probably small things that someone might be able to do. I mean, for the most part, the answer kind of here is like no, not really. And the reason I would say kind of a no, not really on this is like what we're basically looking at throughout this whole process is it's sort of like saying, could someone do games with Bitcoin? It's like, not really, because like what we have at the end of the day is we have this verification of network links. And so we know like if you start selectively delaying packets moving over your network or something like that, we're going to catch that. And that's like not going to be a good situation. And then suddenly you get slashed. And so the you could do this probably like once or twice, right? Something like that. There is always some ability to do something in one of these situations. But the whole thing is just about reducing, like, again, because this is a stateless network, we don't have to catch like one defection in a proof of stake network is the end of the entire security of that network. This is very different because, again, this is not a proof of stake network. This runs on a totally different principle. And so what that means is the way this is set up is just quite different.
Yeah. I'm also trying to understand, like, again, you go back to, talking about how Jump has invested a tremendous amount of time and effort and money into this. Was there reason that in the future, somebody like, I don't know, SIG or Citadel, is there reasons that they would not want to opt in to this? Like, because I think the premise obviously is that if there's no one with kind of outsized control of the network, even if, Jump has like sort of kickstarted it, maybe these firms would want to opt in eventually. But is there a reason, like, can you think of a reason like, they would think that maybe they're getting suboptimal, connections or whatever? Like, is that a concern in the future that, other firms would not, because like Jump is so heavily invested and like so involved? Not to say anything about Jump specifically. I'm just talking about there's like one very well capitalized actor that's kind of kickstarted this.
I don't think so, honestly. And the reason is basically that like the network works on this concept of proof of utility. And so proof of utility is the system where the rewards to a particular link provider are directly proportional to the utility they provide to the network. And so this is very similar to Bitcoin mining, where if I'm producing 10% of the hash power, I get 10% of the rewards, irrespective of anyone else's rewards in the system. And so the nice part about that is it means that like I'm on an equal playing field with Michael Saylor as a Bitcoin miner. I'm not on an equal playing field to Galaxy as a Solana validator, because the amount of SOL that they hold like directly impacts, my ability to, earn rewards, right? Because rewards are proportional in proof of stake networks.
If there's a ton of validator, 000 participants in Tokyo, you may not like necessarily get the same rewards as somebody who's created an entirely new connection elsewhere.
Yes.
Is that correct? Okay. So what is the premise behind that?
So we don't have a concept of passive emissions, which I think is a major feature, not a bug in this design. So most DePIN protocols, they just give out a huge amount of money to basically like, thank you for existing.
It's like subsidy, basically.
Yeah, exactly. And I don't think that's a great way to go about things in this era for a lot of reasons. One of the main reasons is that it just creates market distortions. You create farmers. Yeah. We don't want farmers, right? That's not what we're all about here. And so one of the main components of this for us is like, okay, how do we build a system that doesn't have that type of like vulnerability in it? And so one of these things was creating this system called proof of utility. And so what that does is that means that we only reward connectivity that's actually used. We don't reward connectivity that is just sort of passively sitting there. And so from that perspective, what really, really matters here is what is the ability for a network contributor to provide useful connectivity, not just existing connectivity.
Got it. So like in some ways, being a 000 participant in, like let's say middle of nowhere, I don't know, Madagascar, is not useful unless there's a tremendous amount of demand from middle of nowhere Madagascar to use 000. And then those 100%. Kind of combining create like maybe some outside incentive to, if again, there is demand in Madagascar for somebody to set up, right? Like be an actor in the network.
Yes, 100%. That is exactly the way to think about this. And so if you basically have a system where we've got, X amount of fiber, you may say, hey, look, I'm from Madagascar. I want to bring connectivity into Madagascar. And you know what? Turns out there's also a billionaire here who is in the Solana seed round. And they're going to park 4% in Madagascar and run a validator there. Okay, great. Well, suddenly your network link is actually very valuable.
I see. When you say, okay, it's like quite interesting, this idea, at least conceptually to me, of like proof of utility, because what it means in practice is like you are truly being rewarded directly proportional to the value that somebody will pay to use it. And so like my only question about this is like, how do you quantify, and I have no idea what even would be the variable, but like, okay, somebody uses 000 for one transaction. Like, how do you determine kind of like the marginal value created in that transaction from using 000? Because that really should be ultimately what the value of the token is, right? If it's like purely utility based.
Yeah. Well, yes and no, right? And here's why I'll give you the yes and no answer on this. I think if we start saying the value of a transaction is directly proportional to the fee paid, that's kind of where Ethereum like went wrong on a bunch of stuff. That's not like a good way to go about these things.
Okay, wait, can you elaborate there? Elaborate a little bit.
Yeah, totally.
Maybe I'll agree or not.
Yeah. So I think the minute you start to say a transaction that has more economic value at stake should pay a higher fee, you start to break one of the core principles of blockchain, which is neutral infrastructure.
Right. No. I agree. Here's maybe another way to say it. Like the value in the long run of the 000 token should be essentially a function of the demand to use the 00 token. And
yes.
the reason I say that is because that is kind of not exactly, there's been massive premiums to utility in all these other blockchains like
Absolutely.
you were describing. And yep. You're kind of designing it off the start as, we converge closer and closer to that actual utility.
Absolutely. Yes.
Another thing that I was thinking about, this kind of goes to like the token and token design, is like, this is almost exclusively a B2B utility token. Would you agree with that?
Yeah, just like an Oracle or yes.
Yeah.
Yes.
What would be the rationale for a, retail person to hold the token? Is it that, well, the utility is going to grow, the network utility is going to grow, right? But like, they don't necessarily ever need it, apart from believing that the utility for 00 will grow like multitudes over the next, X amount of years. Is that kind of your thought as well?
I mean, you can play this same question out for every single major L1 in existence, right? 100%. And so this is kind of where it's like, oh man, like if there's all these fast L2s now and it costs nothing to transact and Base literally charges you nothing to transact, why the hell would I hold any Ether?
Yeah.
Right.
No.
And so the only reason I push back on the premise to this question is I think that like there's a few things we sort of see in crypto. The first is like, if I'm not a direct user of something, it doesn't mean that the thing is not valuable. And there might be other reasons why I want to be involved in that thing. Right. The other piece too, I would say, is like users will benefit from 00, unquestionably. Networks that adopt 00 will be able to have much higher transaction, capacity and all these other types of things. And, over time, who knows, we may add other components that end up getting more useful from a user perspective too. Our core here, though, is to accelerate the aggregate performance of all blockchain validator networks and the systems that operate on top of them. And so it's sort of like if you go back to like 2022, Solana's revenue was like $2 million a year. Like it was nothing. There was no revenue flowing through the system. And then you get enough economic activity that models basically find themselves at some point. And so our focus here is on growing the network and the utility of the network and the value that the network provides to people operating on it. And there will be emergent business models and use cases that we haven't even begun to think of yet. I don't think anyone thought like when Facebook started that like it was going to be an ad tech company or Google was going to be an ad tech company, but like that turned out to be like the killer model for Web 2.
You said there's no inflation, right? Like there's a set number of tokens. So in the long run, right? Like in theory, and there's 50% burned, right? Like on one side of this supply.
Yes.
Okay. So, right. Like in theory, the value of 00 goes up, but like the actual, amount paid, like in dollar terms, for example, may be like
it could be steady state. Yes.
Exactly.
And you can still decrease supply. Yes.
Yeah. And then, we'll finish up on like a few last questions about the token specifically. You got this like letter from the SEC, which was, I guess, a big deal, but I don't know exactly what it was. It was like a letter of no action or something like that. What does that mean?
Yeah. So a no action letter is kind of the holy grail in like crypto legal circles. What it is basically you go to the Securities and Exchange Commission before you do something. This is very common in traditional finance too. And you say, hey, we want to do this thing. Can you please evaluate this thing and see if it will run afoul of your current interpretations of securities laws? And they can either opt to not review it. They can review it and give you private feedback that says, yep, this is allowable, or no, probably not. Or in some rare instances, they will publicly post their response about why they think this is not a security transaction. And so what they did in this case is, they responded to us and said, hey, not only do we think this is not these types of transactions you've applied for relief on are not securities transactions, but we think that the rest of the industry would do good to understand that these are not securities transactions. And so they basically provided guidance to folks and said, hey, if your thing looks like this, it's probably good. And so
why aren't more tokens doing this?
They try. There's a graveyard of projects, and there's a lot of mansions in the Hamptons that have been made on projects attempting to get no action letters and lawyers just charging lots of money for it. No crypto project has.
Okay, and then they just give up because the SEC is not going to deem it not a security.
Right. And so, there hasn't been a no action letter for a crypto project in like 4.5 years. We were the first one to get it, and we're still the only one that's gotten one so far. Now, I think when the government reopens, we'll hopefully get a few more coming out of the SEC. But the timing of this was really great for us, and we're really glad to work with the SEC on this. That we found them to be not pro crypto, not anti crypto, just a bunch of folks like doing their job and evaluating whether this would be a security or not, and determining that the types of transactions we applied for relief for are not securities transactions, which is a huge unblock for the project.
Yeah, it's actually like quite interesting. I want to just like dig in a little bit more. Like, what was the design, the way we kind of discussed like this utility first, and also because you're operating at like a much lower or higher, I don't know which way you go, but anyways, lower level.
No
of
one
the
can
stack.
agree on which way the stack goes.
Yeah. You're operating a different layer of the stack, let's say from like L1s and stuff. Did that help? Like in some ways, I use this analogy maybe kind of condescendingly sometimes with other projects. Like it's almost like decentralized AWS credits, right? Does it help that you kind of framed it as like, what was the wording or whatever that kind of made them say like, look, this does, not really resemble what we would think of as a security?
Yeah. So some of this is, I would say speculation is the wrong term, but like some of this is reading between the lines, right? So just to give that appropriate disclaimer, they seem to really like proof of work. They like that anyone can show up at any time in the system and they can contribute to it and they can earn rewards directly proportional to their contribution. If you think about this, like this is like a mine. Yeah. Like if I open a new mine that produces copper, my earnings from that mine are not proportional to how much copper I already own. Right. It's like, it's literally a commodity. It's like I've pulled more commodity out of the ground, and sure, the market dictates how much I get paid for that. But the problem with proof of stake networks is, from a perspective of this is like, well, like you basically bake in a whole bunch of people who already have a thing. Now, of course, what you can say is like, yes, owning, like if you mined earlier, you got more Bitcoin, but that's true in the real world too, right? Like the most productive mines have already been mined. They were the easiest things to do. It doesn't mean that each incremental unit of copper you pull out of the ground, even if it's more expensive, isn't still adding to the global commodities market. And so I think there's a portion of the proof of utility system that they really liked that doesn't require owning a whole bunch of 2Z to become eligible to start. That's definitely one componment. The other one is like
real infrastructure, not dissimilar to mining, right? Like you actually have to do the work. Yeah. I'm not trying to kind of come across too condescendingly toward that mistake sometimes, but I agree. Like when you have actual fiber and it's like you're paying for the usage of a real like meat space asset, like it does make more intuitive sense in the context of proof of work.
Yes. The other component here is like a Solana validator takes a lot of work. Like you have to be updating software. You have to be optimizing it. If you really want to squeeze the most value out of it, you've got to be like moving data centers all the time. That's a lot of work. The SEC likes projects that require a ton of work. Yeah. So from most deep in projects are kind of like set it up and forget about it and check your token balance every once in a while. That's like not as good to them as something like 0.0, where it's like, oh, each contributor has on-call engineers and staff, and it takes a lot of time. And it's like, it's hard to contribute to the 0.0 network. Like I could not do it as an individual if I hadn't, had all this experience in this. It's quite hard to figure out. Whereas like I can start, a node on most blockchains nowadays. Yeah. And so part of this too is like systems that require a lot of work and a lot of active monitoring are much less likely to be seen as passive investments. Yeah. They're it's like owning a mine is maybe a passive investment. Operating a mine is a very active activity.
Yeah, no doubt. And so then like the 0.0, last few questions, the 0.0 token was specifically for validators. Is that correct? Like only validators could buy this. I saw the initial launch, but I never really looked into it. Was this like, so yeah, like,
so we did
there was a pre-sale. Yeah.
Yeah. So we did a token sale to validators back in June, where we sold at 7.5 cents to them. We tried to sell 1.5%. We only sold 80 bips through that process. So we didn't even sell out. And so we sold about half of what we intended to. And this was only available to validators.
Got it. And then the token launched recently and you got like mega screeched at. Sorry, but I had to ask.
Yeah.
Yeah. So like it opened on Binance, right? At like the 7.5 cents roughly. And then like went way up. And I guess the initial people are still in profit, but you've been getting screeched at. I've been reading some of it, but I haven't been like, I'll let you give your side to the extent that you're allowed.
No, totally. I mean, like I'm happy to talk about this stuff because like it's all on chain. So yeah, we did not anticipate anywhere near the demand that we got for the 00 token at open. So, we opened at 7.5 cents on chain. Binance Alpha pulled that in. Things went crazy. Like those who were providing liquidity, like couldn't get liquidity into the markets before, things started going crazy. And so we had a pretty unfortunate spike up at the beginning. The foundation, like all the investors and team is locked. The foundation supply is unlocked, but we haven't sold any tokens from the foundation. This is just what happens nowadays when you launch a token in a bull market. I really wish we could have launched in a bear market like that. I hate launching in kind of an up market because you just get so much market distortion. And so the thing we really try to do.
Sorry, what do you mean when you say Binance Alpha? Like, is this the kind of thing where Binance gives
this is their weird pre-launch
priority?
pad.
Yeah, explain that. Like, if you
So Binance will not launch you on their normal central limit order book. Okay. They just won't for a new token. They insist on going through this thing called Alpha, which is kind of like it's like Dex Screener to CoinGecko or Birdeye to CoinGecko. Like it's just like a less whatever platform. And so by the time but the problem with it is like it's not tied into a lot of market makers and things like that. So by the time they flipped it over to main Binance, the run up had kind of already occurred. And then the minute you start to see people saying, oh, like this thing went up, I should buy it, and you start to see these sort of uncontrolled cycles that kick off from that.
So is Binance Alpha also kind of like gatekept to some extent?
Yes.
Yeah.
Yes. Now we launched on chain, right? And so there's a Radium pool where the initial, market got stood up. And so that was sort of where things started, but then that got pretty saturated by Binance Alpha pretty quickly.
Yeah. So you launched on chain, you launched on Binance Alpha. Any other?
All major, pretty much every major tier 1 centralized exchange we launched on as well.
Hey, Will here with Blockspace Media. Did you know that we have individual feeds for all our shows? If you're watching the Mining Pod, Bitcoin Season 2, or the Court Show, be sure to check out the individual feeds. You can find them on your podcast player of choice, whether that be Spotify, Apple, YouTube, etc. Just type in Blockspace Media and you'll find all our shows pop up, or just type in the individual show name like the Mining Pod or Bitcoin Season 2. Be sure to hit that subscribe and give us a 5-star rating so we can continue to bring you the best content in Bitcoin.
Yeah. Okay. Like just from a conceptual level, I mean, I just want to ask you like on a personal level, like, I will, like I said, I've only just kind of seen people yelling at you, and I say yelling, like maybe they have very good points. Again, I'm not like so in the weeds here. It did like it spiked and then it went down a lot. I was looking, the FTV is not like insane. So, I mean, there's a lot of projects that have still been like out for a very long time that are not, I mean, that are way, way less sort of floated. But like now you have to deal with this, right? Like now, in a sense, you have to deal with not even community members, just people yelling at you. Like, how much of a distraction is this in your mind? Like, do you?
This is having a token.
I agree. I'm just curious.
I mean, like, this is what it's like to have a liquid token. You know, I have 4+ years of Solana for that. So I think we all have pretty thick skin at this point. But, this is what it means to have an asset with a public price that changes every second of every day, 24/7, 365. The crypto markets are brutal because there's never a pause in them.
So just one other quick question. Where is like the float? Like where is that? Like you had some initial supply allocated to Binance Alpha, the Radium pool, like where else? Like who had that initial kind of like float that's out there currently?
Yeah. So this is one of my favorite things because no one agrees on how to count this shit. And it's really annoying. So MiCA, which is the main regulator we submitted our paper to because we wanted the token to be available in the EU as well. They basically use the definition of, which is industry standard, of free float. And free float is equivalent on the stock exchange to basically, and obviously like 00 is not a security, but like how many shares are actually actively tradable and circulating within a market. So if like, for example, you may have a bunch of shares that are owned by the founder, but those are governed by like very strict, transaction provisions and things like that. So those are not considered free float shares.
Right.
So the free float of 00 is about 7.5%. The circulating supply is about 34%. Now, circulating supply is also a metric where there's no definition on. CoinGecko, for CoinGecko, circulating supply is every single unlocked token. For CoinMarketCap, circulating supply are just tokens that are actually circulating. So the foundation supply, well, it's unlocked, it hasn't moved, so it's not circulating. So there's no standardization in the industry for how we actually talk about these things. And it makes it very hard to clearly communicate, because if you look at, for example, the disclosures that we filed with Korean regulators, you will see 34% as circulating supply, because their definition is what is the total amount unlocked. Mika, the question is how much is actually circulating. They use a much more standard definition to the equities market. And for there, it's about 7.5%.
The last thing is, how do these residual tokens now hit the float? You guys don't have a long run emissions plan, like you said, but they're just unlocks over the next 4 years, or
exactly.
kind of standard unlocks.
Yep. So there's a whole PDF with token disclosures on the website, and basically everyone who is a founder, an investor, team, there's basically a 4-year linear unlock with a 1-year cliff from token launch. So very vanilla, standard to every other protocol out there.
Yeah.
And so, there's also obviously the possibility for the foundation to do locked sales, right? Which would add additional lock to the current amount that's at, most foundations, when they do recapitalization events, they sell locked tokens.
Which remain locked though, or no?
Which start a new time period. So, for example, I was involved in the $315 million fundraise of Solana back in 2021. Those tokens were all unlocked. They were the Solana Labs' unlocked supply of tokens. When they sold them to A16Z or whatever, they sold them with a lock, and they were like, okay, we're going to sell these tokens to you at some small discount to market, but in exchange, you're going to have a 4-year linear unlock on these tokens or something like that.
Yeah.
So it's pretty common that tokens get re-locked when the foundation does sales.
I see. Okay. I keep saying last question, but now I'm going to give you actually the last question. And this is more just another kind of your personal thoughts. Do you even care what people on Twitter are screeching about? And I think there's something the reason I'm asking this, I think there is something slightly unique about the sense that you have this whole, right, you're attempting to build this extremely audacious, hopefully reshape the fabric of society type project, right? And
yes,
the demand is going to come from in theory, again, from serious people who need this because it provides genuine utility. It's not exactly a meme coin. And so does it really matter? At the end of the day, you guys executing on your vision and providing tremendous utility is that's going to be what shows the value of the project versus, people online. It's kind of something, I guess what I'm saying is maybe you can ignore this more than some other projects that need a very diamond handed community. I don't know.
I think when you have a real product with real utility, you're always in an advantage to someone who doesn't have a real product that doesn't have real utility. That being said, sentiment really does matter, right? We take these things very seriously because you have to remember, when FTX collapsed and it implicated Solana, even though Solana actually was not actually impacted, the mood and the sentiment was that Solana was somehow over because of this.
Right.
And, if we had basically holed up and said you know what, screw y'all, Solana's great, pay no attention to the noise, we'll be fine. I don't know if Solana would have gotten through it in the level that they did. I was on Twitter day in and day out doing Twitter spaces with Raj and Toli and Ben and, really fighting this FUD, not from the sense of you shouldn't be angry, you shouldn't be mad that your, assets are down so much, but let me make sure you actually have the facts. Here's exactly what happened. Now, you can make your own conclusions on this, but I think, when people operate in a vacuum with no information, they can't make good decisions. And so I see our role in this is making sure that people have the facts and understand what is actually going on. And from there, they make their own decisions. If they want to buy more token, great. If they want to dump the token, great. It is truly this is a free market and you're not going to win people over or everyone over from that perspective. But what you can do is make sure that they're informed.
Well, that's a very admirable goal. Thank you for coming on. Thank you for digging into everything, answering all questions. I thought it was fantastic. Appreciate it.
Thank you.